Dear students, knowledge seekers and learners, welcome to lecture 4 of week 1 wherein we are going to discuss about the elements of financial system. Let us begin the journey. Today we'll be starting by understanding the meaning of the elements of financial system followed by the elements versus components discussion. After that, we'll try to understand the core elements of financial system followed by the functional role of each element. After that, we'll try to learn about the interaction among elements of financial system, followed by the efficiency of financial system. In the end, we will take up a case study. We will try to understand in that case study about capital flow in practice. At the very outset, it is important to discuss the meaning of elements of financial system. Elements refer to the functional building blocks of the financial system. These elements explain how the system operates in practice. That is, what is the working mechanism of a particular financial system. In this scenario, the focus is not just on what exists, that is component, but the focus now is on how these parts perform their role. Thus, it is not just the information what is, but it is also how these things and entities perform different roles in a financial system. Thus, elements of financial system are the operational perspective of financial system. Without elements, a financial system cannot perform its operation. Let us now try to compare between elements of financial system and components of financial system, as these are the most confusing terms and students do get confused in these two terms with respect to financial system. With respect to the basis of focus, components are a structure and elements are the functioning entities. With respect to the nature, components are descriptive in nature while elements are analytic in nature. Examples of components includes markets, institutions. Examples of elements constitutes flow of fund, intermediation. If we talk from a perspective of approach, components talks about what exists, while elements talks about how these existing entities work, that is how it works. Let us now try to see the core elements of financial system. The financial system operates through financial institutions, financial markets, financial instruments, financial services, and now another one, that is financial intermediation. Intermediation is the linking force between all these entities. Thus, it is very important. Let us now talk about financial institutions as an element. Financial institutions act as intermediaries between savers and borrowers. They perform the task of deposit mobilization, which means that savers are motivated that their saving be mobilized to enter into the organized financial system, and therefore it can be used in terms of investment. This whole cycle is deposit mobilization cycle. The second is credit allocation. Those entities that are deficit in terms of credit facilities, to provide credit to them is also very important. Intermediaries also reduce information asymmetry, that is, they appear to be a bridge between the financial institutions and final consumers of financial services. Intermediaries also enhance trust in the system by bringing transparency and accountability. Thus, intermediaries are not just entities, but they are functional agents in a financial system. Let us now talk about financial markets as an element. Financial market as an element provide a platform for buying and selling financial assets. They enable price discovery, liquidity, and resource allocation. Financial markets as an element also reflect the demand and supply of funds dynamically. Let us now talk about financial instruments as an element. Financial instrument as an element represent claims on future income or assets. It also serves functions such as investment, risk diversification, liquidity provision, etc. Financial instruments as an element convert savings into investable assets and thus provide an opportunity for the economy to achieve economic growth and development. Let us now talk about financial services as an element. Financial services facilitate a smooth functioning of a system. These financial services include banking services, insurance services, and advisory services. All three services are relevant and important for a smooth functioning of a financial system. Thus, the financial services improves efficiency, accessibility, and reliability. Let us now talk about financial intermediation. Financial intermediation is the process through which funds move from savers to buyers, from savers to borrowers. This intermediation is done by different institutions such as banks, NBFCs, non-banking financial companies that are partly regulated by Banking Act and partly regulated by Companies Act, financial institutions. The financial intermediation reduces risk, transaction cost, and information gaps, thus providing an opportunity for the financial system to grow as well as become financially stable. Financial intermediation thus appears to be most critical operational element in the financial system. Dear students, knowledge seekers and learners, it is time that we should try to focus on flow of funds mechanism. So we know that fundamental mechanism starts from saving, where savings are mobilized and transformed and put into financial institutions, and these institutions that turn these savings into investment. Thus, flow of funds mechanism ensures capital formation and it also promotes economic activity. The most important point to be noted under flow of funds mechanism is that it avoids idle resources in the economy as well as there is continuous circulation which is put into force so that it becomes an essential part of flow of funds mechanism. In addition to all these things which we have discussed, the role of intermediaries in financial system needs to be appreciated. There are pool of small savings which can be converted into large funds, but it is only possible through intermediaries. Intermediaries also provide credit assessments, which means that the credit worthiness of people, households, firms is being decided by the role of intermediaries such as the credit rating agencies. Not only this, intermediaries in financial system also are responsible for diversifying the risk and enables access to finance for weaker sections or the unbanked people. In addition to this, Intermediaries also support financial inclusion, which is again for the unbanked people. Thus, we can say that intermediaries in a financial system are the backbone of financial system efficiency. Let us now try to identify the link between all these elements which we have discussed. Institutions, that is financial institutions, use financial markets. Financial markets trade instruments, thus institutions are linked to markets. Markets are then linked to instruments. Services supports the transactions, so instruments and all these are linked. And finally, intermediation connects all. Thus, the whole financial system works only when all elements are integrative, cohesive, and collaborative. Dear students, knowledge seekers, and learners, let us try to identify the efficiency of financial system. The efficiency of financial system depends on the speed of fund transfer, transparency, risk management, accessibility, lower transaction cost, and strong regulatory framework. The speed of fund transfer refers to how quick money can go from one entity to another entity. Transparency refers to the disclosure of all the necessary information that the stakeholders in a financial system should be aware about. Risk management refers to adopting strategies that can gradually mitigate risk and should promote risk sharing instead of risk transferring. Accessibility refers to the smooth access of finance for people, entities, and institutions without any bottleneck. Lower transaction cost refers to per unit of money spent on doing a financial transactions. A strong regulatory framework refers to a regulatory framework that can control and monitor the financial system, that should not be biased, that should not commit fraud, etc. Thus, an efficient financial system can result into higher economic growth as well as economic development. Let us now talk about financial deepening. Financial deepening refers to expansion of financial services and instruments to those sectors that are still out of bound. The different indicators of financial deepening are increase in banking access, that is, more unbanked people should become part of formal banking system, growth of markets, higher investment levels, etc. Financial deepening is a sign of a developing and mature financial system. What are the different challenges in financial system elements? Financial system elements refers to information asymmetry, which is a problem for financial system elements. More information asymmetry result in more panic in the market. Another challenge in the financial system elements is lack of access in rural areas, that is still a problem. The third challenge is market inefficiencies. Some markets are inefficient than others, and then the problem starts that more funds flow to the efficient market, thus creating a deadly situation for inefficient markets. Finally, another challenge is financial instability that may come particularly in times of geopolitical crisis. Thus, we need to understand that weak elements reduce system performance. Let us now try to understand the information flow as a financial system element. Information is power. Information, if we get at appropriate time, can improve the effectiveness and efficiency of our decision making. As the whole financial system depends on decision making, and decision making depends on information, the information flow is a very important financial system element. financial decisions depends on timely and accurate information. The more accurate the information, the better the decision. The more timely we get information, the better the decisions. Let us try to delve a bit deeper into what do we mean by timely information and accurate information. Timely information refers to when we want to take a decision and we have substantial time to take a decision. If within that period of time we get the appropriate information, then it is timely. Another indicator is when we are able to interpret, analyze the information, we get that much time that we are able to analyze the information which we have collected. Then again it means we have got timely information so that we can act upon it. Another important constraint related to accurate information is that it should be verified, it should be reliable, and it should be relatable. So these are three characteristics. It should be reliable, relatable, okay, and these two are more and verified. All these 3 points, they point out towards the authenticity of the information. Information authenticity is very important for having confidence in decision making. There cannot be any confidence in decision making if there is no proper authentication. Thus, these 3 characteristics, that is reliable, information should be reliable, we be able to rely, relatable with the situation which is prevailing, and verified is very important. If all these 3 components are not present together, then we cannot call the information to be accurate. Information supports investment decisions. How they support investment decisions? We want to invest in X company. Do we have some information about X company? Do we know what is going on with respect to expansion, diversification, or auditing into that company? Let me add you to your knowledge that there are so many news agencies and companies who report news of companies. You have newspapers like Business Line. You have newspaper like Economic Times. You have news agencies, international news like Reuters. Okay, now what all they are doing? Who is interested in knowing about what businesses are doing? Investors, because they influence the investment decisions. A particular company is going to merge with whom? This information reflects the market price of those companies. So investment decisions are quite influenced because of these things. Similarly, Reuters, if you take the example of Reuters, Reuters is a very expensive subscription-based news agency where business houses, they are subscribing it to get wire information. What is a wire information? Wire information is a brief information. It is 2 lines information that X company, there is a news that X company is going to go for negotiation for merger with Y company within next 7 days. Only this much. Now this small information, which appears to be small, can influence lots of investment decisions. So all these things are dependent on information flow. Information also supports credit evaluation. Credit evaluation refers to that what is the status of credit which we have taken or which we are planning to take. Whether we will be able to repay the credit, whether there is some default risk. All these things are undertaken under credit evaluation. The third is risk assessment. Again, risk assessment depends on information, the company's creditors, the disclosed as well as undisclosed information. Sometimes companies go for cosmetic changes with an attempt to hide their actual positions with respect to loans, borrowings, and creditors. So, accurate information pertaining to these items of the balance sheet are very important for assessing the risk appropriately. Now, use of information flow as a financial system element, what does it do? It reduces uncertainty, because when we have so much information, we can use this information to refine our decisions, and when our decisions are evidence-based decision, the uncertainty goes down. So it reduces uncertainty in the financial transactions. Information flow also enhances transparency and market confidence. Both transparency and market confidence are important elements. Information flow also is a possible approach in which efficient information flow improves overall financial system performance. So collectively we can say that it is a very interesting phenomena where information flow is a financial system element, and it provides evidence and certainty in times where financial decisions are to be taken based on critical information. Dear students, knowledge seekers and learners, let us now talk about trust and confidence in financial system. These two attributes, they are known as attribute because they are characteristics. Attributes are characteristics which are qualitative characteristics. So trust and confidence are qualitative factors. Though they appear non-measurable, yet their relevance cannot be undermined. Trust and confidence in current times are very rare and very precious assets. No organization wants to leave a trusted employee. No organization wants to lose confidence in their investors. So both are very important. Financial transactions largely operate on trust. Imagine a scenario where your family have started losing trust on any bank in which your money is there. What will you do? You will start taking out your money. And suppose all people of a bank, if they realize and start losing trust in their banks, all of them will reach to the bank for taking out their money, and then a crisis will come because everybody may not be able to get their money back. So it is only trust that is running this system. So financial system and financial transactions largely operate on this trust system. Depositors trust banks to safeguard funds. Why we all are keeping our money in bank? Why? Because we trust that our funds are safe over there, and whenever we want our money back, we will be able to get the money. Another important thing is investors trust markets to ensure fair trading. The trust of the investors in financial markets prevails only when they have an idea and perception that fair trading is taking place. Also, confidence encourages participation in financial activities. The confidence is a very important thing which encourages participation in financial activities. Financial activities considers all activities that are running within the financial system. Trust and confidence are also very important because there is loss of trust that can act negatively in the financial system. So while trust promotes the financial system, the opposite of it, that is lack of trust, it degrades the financial system. Loss of trust thus can lead to financial instability, doubt about financial transactions and financial markets, etc. Thus, it is justified to say that trust acts as intangible but essential element of the financial system. Let us now try to understand technology as an enabling element. So, technology is a contemporary issue and we need to understand its impact in a very substantive manner. Technology has transformed financial system operations. Technology facilitates digital payments, online banking, real-time transactions. Now, all three are very relevant in the contemporary and modern times. And the modern times are defined by these features, that is digital payments, online banking and real-time transactions. It is very common knowledge that without the digital system which are prevailing right now, we cannot have an improved system. Thus, it is very important to understand these issues. Also, technology reduces the transaction cost by minimizing the use of resources in substantive manner. In addition to this, technology also improves accessibility and efficiency. Now, you need to understand what is accessibility in terms of technology. Any particular banking sector reform, if you see, it forced people to come to the bank. So, any reform initially started where people were asked to come to bank. Gradually, the reform pushed bank employees out of the bank so that the people can reach easily. Technology, what it has done, it has reached to the doorsteps rather to in the hands of the people. You have your mobile phone. If any person in India right now has a mobile phone, then they can easily get connected to the banking or the financial system with the use of technology. There is no need to move either to the person concerned or to anybody who is in the financial system, a bank employee or an employee of financial intermediaries. Nobody is required. So this is the power of technology, and by this we mean accessibility. Everybody now can access the financial system. Thus, technology strengthens connectivity among all financial system elements. Let us now talk about regulation and governance. Regulation ensures orderly functioning of financial institutions and markets, and this functioning is appropriate as well as it is quite interesting because these two together they work to provide a substantive efficiency. Regulation and governance together promotes transparency, which refers to disclosure of all necessary information to the stakeholders, accountability, which is fixing responsibility in times of crisis and losses, as well as investor protection, where they can be protected for their rights and for whatever amount of money they have invested. Regulation and governance also helps to maintain financial stability by providing a controlled environment. This controlled environment is also free, but it is under the regulation through which excessive greediness, etc., can be minimized. Also, whenever financial bubbles are being created due to lack of regulation and governance, it is the responsibility of the government to further enhance regulation and governance. Also, regulation and governance encourages confidence among market participants as well as improves the trust in the market participants. Thus, effective governance supports sustainable financial development, and regulation is a complementary element in financial system. Let us now try to deal with a case study based on credit flow through banks. We have a scenario that is MSME lending in India. Small businesses require funds. Banks provide loans after assessment. That is the scenario. What is the process? Deposits are collected from public. Loans given to MSME, that is micro, small and medium enterprises, and businesses invest and generate income. So the case insight is that this case demonstrates how financial intermediation in action is possible. It also shows how savings are transformed into productive investments. Another point highlighted is the role of institution in supporting economic activity and employment. Thus, the real world functioning of financial system elements can be deciphered from this case study. Dear students, knowledge seekers and learners, let us now summarize what all we have discussed in this lecture. We have appreciated that elements of finance explain how the financial system operates. We have also appreciated that intermediation is the core connecting mechanism in a financial system. We have also learned that in a financial system, all elements are interdependent and they should work in coordination and collaboration. And finally, in a financial system, efficiency depends on coordination and functioning. Dear students, knowledge seekers and learners,